There's a business card on this desk. The company it represents is registered. It has filed paperwork. It has an address somewhere in the world, and a director listed on a government registry. But if you walked to the address, you wouldn't find an office. There's no front door for this company, no staff, no website you can verify, no products, no customers. And yet, last year, millions of dollars passed through its bank accounts. This is a shell company. And today we're going to explain something most people get completely wrong about them, including most reporters, most internet commentators, and even many people who use the term every day. Because shell companies aren't always illegal. They aren't always criminal. They aren't always hiding something. But when they are, they're one of the most powerful tools in financial crime. So let's go inside the truth about how they actually work. Money Crimes Decoded. Let's start with the simplest possible definition. A shell company is a company that has little or no active business operation. That's it. That's the technical truth. Nothing more, nothing less. Notice what that definition doesn't say. It doesn't say criminal. It doesn't say illegal. It doesn't say secret. A shell company is simply a legal entity that exists on paper but doesn't conduct ordinary business activity. And here's something that surprises many people. Shell companies are everywhere. Major corporations use them. Investors use them. Real estate developers use them. Pension funds use them. Law firms use them. Sports teams use them. Even governments use them. The reason they're so common is simple. They're useful. A shell company can hold a single piece of property cleanly, so it can be bought and sold without the legal complications of transferring the underlying asset. It can isolate a risky business venture from a parent company, so if the venture fails, the rest of the business is protected. It can hold investments in different countries without forcing the owner to be personally exposed to every local tax and regulatory system. It can simplify joint ventures, where two real companies want to work together on one specific project without merging. In all of these cases, the shell company is doing exactly what it was designed to do, quietly, legally, and without controversy. So, if shell companies are normal and useful, why do they show up in almost every major financial crime case in the world? That's where it gets interesting. The same features that make shell companies useful for legitimate purposes make them irresistible to criminals. There are 4 reasons in particular. 1. They create distance between a person and an asset. When you own something in your name is on the paperwork. When a company owns it, the company's name is on the paperwork. And when a company owns it, and that company is owned by another company, the chain begins. Each layer is one more wall between the real owner and the real asset. For a criminal, this is gold. Distance is disguise. 2. They can hide who's really in charge. Many countries allow companies to be set up with directors and shareholders who aren't the people actually running the business. These are called nominees. A nominee director might be a lawyer, a corporate service provider, or even a relative. They sign the paperwork. The real controller stays invisible. 3. They move easily across borders. A shell company in one country can own a shell company in another country, which can own a bank account in a third country, which can transfer money to a fourth country. The legal and regulatory differences between jurisdictions create natural friction for investigators, exactly the kind of friction criminals exploit. 4. They're cheap to create and operate. In many places, setting up a company costs a few $100s. Maintaining it costs even less. For a criminal trying to disguise the movement of millions of dollars, the cost of building an entire structure of shell companies is trivial. The math always favors the launderer. These 4 features, distance, anonymity, mobility, and low cost, are exactly why investigators see shell companies behind so many large financial crimes. They aren't the crime itself, but they're the architecture that makes the crime possible. So how do investigators tell the difference between a legitimate shell company and a suspicious one? They look at 5 things. 1. The address. Legitimate shell companies are often registered to a corporate service provider's office, a real legal address used by professional firms. That's normal. But suspicious shell companies often share addresses with hundreds, sometimes thousands of other shell companies. Entire buildings in major financial hubs serve as the registered address for vast numbers of paper entities. When a single building is home to 10,000 companies, the address isn't a business location. It's a mailbox, and investigators know it. 2. The employees. A real business, even a small one, has people. A suspicious shell company often has 0 verifiable employees. No payroll records, no HR filings, no LinkedIn presence, no one who can be interviewed. The company exists, but no human can be found behind it. 3. The business activity. A real company describes what it does specifically. We import textiles from Vietnam and distribute them across the Midwest. We develop residential properties in suburban Toronto. We provide industrial coatings to automotive manufacturers. A suspicious shell company often describes its activity in vague, generic language. Consulting, trading, investment activities, general services. The vaguer the description, the easier it is for almost any transaction to look consistent with the stated business, which is exactly the point. 4. The directors. Suspicious shell companies often have directors with no business background, no public presence, or names that appear as directors of dozens, sometimes hundreds, of other companies. When the same individual is listed as the director of 200 different entities across multiple industries, they aren't a director, they're a nominee. 5. The transactions. A real business has transactions that match what it claims to do. A textile importer pays for shipping. A property developer pays construction companies. A consultant gets paid by clients whose names line up with their stated expertise. A suspicious shell company has transactions that don't fit. Large transfers from companies in unrelated industries, payments to and from individuals with no apparent business relationship, money entering and leaving the account without any pattern that resembles normal commerce. Together, these 5 signals form the profile of a shell company that exists not to do business, but to create cover for something else entirely. This is where shell companies become truly powerful and truly difficult to investigate. A single shell company is one layer, but the real architecture of financial crime usually involves chains of shell companies. Think of it like nested boxes. The asset, a property, a yacht, a portfolio, a stake in another business, sits inside the smallest box. That box is owned by a slightly larger box. That box is owned by another box, and another, and another. By the time you reach the outermost layer, you've passed through 3, 4, sometimes 10 different companies, often registered in different countries, each with its own directors, its own filings, its own legal framework. To an outsider, it looks legitimate. Each company has paperwork. Each company files its returns. Each transfer between layers has a stated purpose. The whole thing is meticulously documented, but the meticulous documentation is the disguise. The whole structure exists to make ownership of the underlying asset look traceable while actually being unreachable. For investigators, unraveling a chain like this can take years. Each layer is a request to a different country, often translated into a different language, often answered slowly, sometimes resisted by jurisdictions that benefit from the secrecy economy. But here's the thing investigators count on. Every chain eventually ends somewhere. There is always, always, a real person at the top. Someone has to sign the last document. Someone has to receive the income. Someone has to give the instructions. The chain is built to delay discovery, but it cannot eliminate it. When investigators reach the top, the entire structure collapses, and often the moment of discovery is anticlimactic. It's not dramatic, it's just a name. On a piece of paper, behind 9 layers of paperwork, sitting somewhere very far from the country where the crime was committed. That's the truth at the top of every chain. And finding it is the entire point. For most of modern history, shell companies have been one of the hardest problems in financial enforcement. Each country regulates them differently. Each country guards its corporate registry under its own rules. Each country has its own definitions of who has to be disclosed and who doesn't. But over the past decade, something has been shifting. A growing number of countries are pushing for beneficial ownership transparency, the legal requirement to publicly identify the real human being who ultimately owns or controls a company. Some countries have built public registries. Some have built private registries available only to regulators. Some have built systems that require beneficial owners to be disclosed only under specific conditions. The progress is uneven. The push is contested. Some jurisdictions resist it strongly, often because the secrecy economy is a significant part of their financial sector. But the global direction is clear. The hide-behind-layers strategy that worked for decades is becoming harder year by year. This matters because of one fundamental truth. The strongest defense against financial crime isn't catching criminals after the fact. It's making secrecy more expensive. Every layer of beneficial ownership transparency makes shell companies less useful to criminals. Every public registry shrinks the space where money can hide. Every cross-border information sharing agreement makes the global financial system slightly less easy to exploit. The criminals adapt, of course, they always do. New jurisdictions, new structures, new layers. But the work of transparency raises the floor on what laundering costs. It doesn't end the problem, it just makes the problem harder. And in financial crime, harder is the same thing as catchable.
So why does any of this matter to ordinary people? 3 reasons. First, shell companies aren't theoretical. They affect the real world. They affect housing markets, where anonymous companies buy property in cities where ordinary residents are being priced out. They affect business competition, where companies powered by laundered money can underprice competitors who play by the rules. They affect public budgets, where money that should have been taxed sits in offshore structures instead. Second, once you understand shell companies, you start to read the news differently. Every major financial scandal, every major corruption story, every major sanctions case eventually involves a chain of companies leading somewhere unexpected. Now you'll see those chains for what they are. You'll spot them. You'll understand what investigators are working through. You'll grasp the patience required. Third, and most importantly, shell companies illustrate the central truth of every episode on this channel. Financial crime depends on disguise, distance, layers, complexity. The criminal's job is to make the simple look complicated. The investigator's job is to make the complicated simple again. A shell company isn't magic. It's just paperwork. And paperwork can always be read, sometimes slowly, sometimes by people in 3 different countries working together, sometimes by investigators willing to wait years for a single piece of information to surface. But it can always be read. That's the hidden truth about shell companies. The disguise is impressive. The architecture is sophisticated. The defenses are layered. But underneath all of it, at the end of every chain, there is always a person. And that person, eventually, gets named.
If this episode helped you see something most people walk past every day, that's exactly what this channel was built for. Shell companies are everywhere. Most of them are doing nothing wrong. But the ones that are, and the chains they form, explain more about the modern financial world than almost any other single topic. Subscribe to Money Crimes Decoded for weekly deep dives into the hidden side of financial crime. Every week we cover one new red flag. Every month we go deeper into one major pattern. And every episode is built to help you see clearly in a world designed to keep you distracted. In the comments, tell me, which part of this surprised you the most? The way legitimate shell companies and suspicious ones look identical on paper? The way chains of companies can hide ownership for years? The way transparency is slowly changing the global game? Drop your thoughts. The most thoughtful answers often shape future episodes. Until next time, keep watching the money.